power price, our bottom line looks better. The second reason being we are also running a few gas-fired power plants in Europe, and through those gas-fired power plants we're covered as an operator under the EU ETS. So we're quite familiar what Robert was just discussing about verification procedures as well. We are also active in the B-PMR as a steering committee member, and we feel we have kind of responsibility as well. We see in Europe quite a long surplus, like has been discussed by the previous speakers as well. And we're also looking for new markets, new sources of demand. And we see now trends towards bottom-up initiatives. All kinds of countries around the world are setting up their own trading schemes, but there should be some coordination so we can link those schemes in the future together so that we can lower the overall global abatement cost curve. I think the World Bank is playing a very important role in that, where they prepare, let's say, the public sector, and we are preparing the businesses as well. Because without those businesses, we're not going to be able to control climate change. Oh, it's the wrong one. Okay, well, but then a tragical incident in Fukushima happened, which leads the German Chancellor Angela Merkel to decide to accelerate the phase out of nuclear power. Nuclear power is not producing any emissions, but that power demand has to be replaced by other sources of power. In Germany, it's mainly coal. Coal is emitting a lot of carbon, and there was more demand for carbon, so prices went up a little bit. Then we had the euro crisis, and then if you see it, July 2013, backloading, we have a surplus in the EU ETS. Discussions are being held to withdraw 900 million tons of carbon credits from the market, delay them in auctioning in order to increase the price, but the delay in auction is not enough to take the surplus out of the market. So in the meantime, we have a few years' time to work for a permanent solution and to hopefully cancel those allowances definitely. What is driving the carbon fundamentals? Economic growth, I already discussed that. If we consume more, if the economy is growing, that needs to be fueled by energy. Power needs to be generated. Fossil fuels have to be burned, so carbon prices will go up. Weather can have a short-term effect on the market as well, but we see in Scandinavia, for example, there's a lot of hydropower. If we have an extreme wet year, the Scandinavian countries are actually exporting their power to Germany. Germany is a lot of coal-based. That doesn't have to be generated. So there's less demand for emissions. The carbon prices can go down. In a very dry year, you will see the opposite situation. Fuel prices is very important. If you're a utility and you own a fleet of power plants, you're per definition short fuels and long power. You need to procure the fuels in order to generate the power. And utilities typically do that on hedging for a period of 3 years in the future. So they, for example, have a risk policy that they need to have hedged 80% of their production for the coming year, 60% for year 2, and maybe 40% on year 3. Those percentages are fictive. They depend on the risk appetite of utilities. Coal is emitting roughly twice the amount of carbon if you would generate a megawatt hour compared to if you would generate the same megawatt hour by burning gas. If you have a high carbon price, there will be a switching point, a point where a utility is indifferent as how to generate its power. So in other words, he couldn't care less from a profitability point of view if he would generate that same megawatt hour power by burning gas or by burning coal. And this is exactly one of the cheapest ways to abate in Europe. What we see unfortunately now is that the so-called dark spread, which is basically the difference or the profitability of a coal-fired power plant, is in the money, and the gas-fired spark spread is out of the money, which means utilities have an incentive to build coal power plants in Europe at the moment. And then, of course, you lock emissions in for decades to come. So that's not a good development. Any market is subject to regulation, but this market has been created by regulation. So it will be very sensitive to any changes in regulations. And the last point is linkage. Already discussed, you see a lot of bottom-up initiatives happening all over the world. If markets get linked to each other, there's an influence on each other. Carbon will be influencing other carbon markets in the world, and hence you have to take that into account. And you can rely on analysis, but our experience is always be active in the market as a first mover, and you gain a lot more intelligence. So these were the fundamentals of the carbon market. Now let's have a look at a few business cases, how you actually can make money in this market. You have two companies. If you look at the table below, Company A and Company B, they receive from the government 100 carbon credits. Company A is expected to emit 100 carbon credits, and Company B is expected to emit 120 carbon credits. The market price is €4. Company A's internal abatement cost is only €3. So the cost to internally abate and create a surplus is lower than the market price. So that company will have an incentive to invest in reduction projects internally. Company B, internal abatement costs are higher than the market price. So this company should not bother at all. It should just simply buy the allowances on the market. But of course, this requires an investment. There's uncertainty around it. You don't know how many credits you will reduce and in what time frame. So you really have to take that into account. So it's very important when you start that you start to understand what is the forward curve. And if the market starts, there's not a very liquid forward curve. So try to construct an internal forward curve. Business case 2, offsets. What European companies have done is they went investing in the CDM and JI markets big time. They basically started buying all kinds of emission reduction projects around the world. They diversified across countries, technologies, and project stages in order to build up a nice portfolio. You have to take into account that some of these credits might not be eligible in certain markets. In other markets, they might be eligible. These offsets tend to be a lot cheaper than internal abatement projects, but they're also more risky. You have to deal with counterparty risk, country risk, technology risk, and regulatory risk. And especially when the governments are changing the regulations during the game, it's very risky. You could be confronted with big losses. This has happened with some European companies who invested, for example, in the HFCs and N2O projects. That was it. Well, okay. I just wanted to say one thing around that is that, can the slide maybe go back for a second? Yeah, so what is very important is that you do have a volume risk. You don't know how many credits are coming out of that project. So by building up that portfolio, you get a natural diversification. One project will overperform, another project will underperform. So by doing that, you reduce your risk reward of your portfolio. Next slide, please. Then banking and borrowing has already been discussed. In Europe, you receive your allocation in February for the current year, but you only need to surrender emissions of the current year in the next year in April. So effectively, you could borrow from future years. And depending on the forward curve, whether or not it's in contango or in backwardation, you could actually make money by playing this banking and borrowing business case. Last business case is yield arbitrage. Yield arbitrage is basically something what in Europe there has been enormous high yield in the EUA market. What does that mean? Well, basically the forward curve is steep in contango, and in combination with low interest rates, you can actually earn risk-free profits. And I think this is what a lot of the banks, a lot of the utilities have done in the past. Unfortunately, that yield is now, I think, around 2.5–3%. So it's not that interesting anymore if you have a borrowing cost of more than 2%. How does it work? Well, you need to secure the financing. You buy the commodity on the spot, and you sell the commodity on a forward basis. Ideally, you sell it on an exchange as a future, where you have daily margin in place, and you don't run OTC counterparty risk. Then you store the commodity. Storing this commodity doesn't cost you anything. It's a complete virtual commodity. It's an internet account. I think in Europe you pay a few €100 to have an account. So the storage costs are negligible. It's not like you have to store oil or coal in a tanker. And the last part, what you do is you deliver those credits you bought in the spot market into your short futures position to honor that short obligation. You repay the financing cost, and your remaining cash is actually profit. And because of the recession and the low carbon prices, this yield game has kept a lot of companies alive in Europe. Because right now, you see that there's, if you do client business, you can take a few cents maximum. So that's not able to generate a lot of profit. It remains to be seen what's going to happen in the next years, because this yield is not in there anymore. So we expect more players to exit the market as well, players who don't have a natural position. We already see that happening in Europe. Banks have exited the market because they have new regulatory requirements on the Basel III or on the MiFID. And for them, they need to keep more cash available as a buffer, so they need to take higher margins on it. It's a pity seeing those banks going, because they provide the necessary liquidity and price discovery in the scheme. So it's not a good development. Last point, the conclusion is basically, just trial and error. Basically, try to create a forward curve, although there might not be any trading. Try to think at which price levels I become a buyer of credits, and at which price levels I become a seller of carbon credits. You need to continuously monitor your position and schedule ahead. Make sure you have already early discussions with verifiers to not run into problems towards the year at the end. And yeah, basically, if you don't do anything, that's actually speculating, because you have a position. Prices are moving. A lot of companies are reluctant, don't do anything, but they don't know they effectively speculate because they do have a position. I think I would like to leave it there. Any questions?